What's going on, guys? My name is Freddie Finance, and in this video I am going to be going over the 5 biggest investing myths and debunking them, so hopefully you can have a clearer head on your shoulders for making investment decisions. Myth number 1, you have to invest at the right time. The truth is, when it comes to investing in the markets, there's never a right time. When the market is hot and everyone is talking about how a certain stock is a winner, you're gonna be much more tempted to dive in. And on the flip side, when the market is taking a downturn, you may feel wary and want to pull out. Truth is that nobody understands, or nobody has a crystal ball on where the market is heading, and it is impossible to predict. Trying to time the stock market is just like gambling. It's anybody's guess. But if you pull back your view and look at the long-term performance of all markets, the general trend is that stocks move upward. Even after crises like the Great Recession and the Great Depression, the markets have rebounded quite well. In fact, the average stock market return of the S&P 500 is around 10% annualized. So the bottom line, the best time to invest is when you are ready. Understand that you're in it for the long haul and you have your financial goals identified so you can take the calculated risks associated with it. The best time to invest is the day you start. So just start. Myth number 2, you need to know everything about markets before you start investing. You should start with what you do know and keep learning from there. Gathering information and doing research is an important part of investing, but too often people hesitate to get started because they think they need to know far more than just the investing basics. That means not just stocks, bonds, but options, futures, cryptos, commodities as well. And there are 2 reasons why this perspective is so misleading. First, markets are imperfect. They can sometimes move in ways that take stock market experts by surprise. So a new investor hoping to acquire the right amount of information before starting is just never going to get there. There's just too much information out there and it'll be information overload. You have to be willing to take a leap of faith based on the knowledge you do know, keep that long-term view in mind, and take it by ear. The second misleading perspective about how you need to know everything at once is that the most experienced investors don't try to master each type of investment all at once. They do their best to understand each scenario and make their decisions based on how those investments will fit their portfolios and their financial goals. But mainly they learn as they go. So if you have no idea where to start, be sure to follow Finance and Fitness EDU on Instagram. This will be a program to teach you the pillars of finance and fitness so that you can take control of both your bank account and your body. Oh, and if you're learning a thing or two, don't forget to smash that like button and smash the subscribe button for more applicable information to enhance your life. Now, myth number 3, never invest when the market is down. A down market is almost always the best time to invest because it's like buying your favorite things for a discount. When the market dips, it is always due to external factors such as global disruptions, economic shifts like spikes in interest rates, inflation, or unemployment. But this causes the stocks of many solid companies to trade at a discount to what their true value is. That's why investing when the market is down is a great buying opportunity. Because when the noise settles, stocks with solid underlying fundamentals and high earnings potentials will return to and most of the time exceed their previous highs, leaving you with big gains. But buying low is a mindset that takes time to get used to because it's kind of counterintuitive, which is why having that long-term horizon is so important to stay away from having the fear of further losses. The good news is, if you're getting started in a down market and you're focused on solid investments, you can buy low and potentially come out ahead. Myth number 4, you don't need to invest outside of your retirement account. you actually may find more opportunities outside of your retirement account. But don't get me wrong, investing for retirement is incredibly important and should be a priority. Not only are you saving for the future, but you'll benefit from the many tax advantages retirement accounts such as employer-sponsored 401ks and IRAs offer. But with that being said, depending on your financial situation and goals, retirement savings may not be the only investing you want to do. This is because of the limitations these retirement accounts impose. For instance, in 401ks, you're limited to those options inside that 401k plan. And you may find that you want more choices when it comes to targeting other financial goals. With your IRA, you are able to choose a plethora of investments and you're not as limited as you are with the 401k, but you're limited to the amount you can invest per year. In 2022, the maximum you can contribute is $6,000 if you're under 50 and $7,000 if you're over 50. And in 2023, they are upping the contribution limits to $500 more. So that's great, but it still might not be enough for you to achieve what you really want to out of your financial goals. And then myth number 5 is that being a successful investor takes a lot of time. The reality is, investing doesn't have to eat up your entire life. When most successful investors are getting started in investing, they choose investments with the potential for growth over a long period of time, which helps them fulfill their long-term financial goals, such as retirement or paying for your child's college tuition. And when you take that long-term approach, you won't need to track all the daily ups and downs. You can leave that to the day traders and leave that stress to them as well. But when you're in it for the long haul, you can kind of set it and forget it. Set your investments on autopilot by setting up auto contributions and knowing that the market has its ebbs and flows, and you don't need to stress about the day-to-day things. I hope this helps you guys clear up some of the air of these investing myths, and catch you guys next time.